NASDAQ stocks, and options. And I'm not going to hold anything back from you, not one single thing. I'm not going to waste your valuable time with pointless sales presentations. And instead, I'm going to teach you several actionable trading tactics that you can apply to the markets right away. I'm not going to teach you some rare pattern that comes along once every decade. Instead, I'm going to teach you strategies that are grounded in statistical backtesting, and more importantly, over 2 decades of professional trading experience. First, I'm going to explain how professional trading strategies evolved over the past 40 years. And not only what I'm going to show you will surprise you, but more importantly, I'm going to show you how the retail trader or the average trader can profit from this evolution. The great majority of retail traders continue to use strategies and tactics that were invented or created before the first man landed on the moon in 1969, and expect these strategies to compete with state-of-the-art professional trading tactics employed by institutional traders. So today I'm going to show you how these strategies progressed over the years, so that you can stop using outdated tactics that stopped working decades ago. Next, I'm going to teach you the single biggest difference that separates the multi-billion-dollar institutional trader and the retail trader. Once you understand the fundamental difference, I can bet that you'll never look at the markets the same way again. Moreover, leveraging this knowledge can help you earn more money from the markets, regardless of what market you trade or what time frame you utilize. So whether you're a long-term investor, a swing trader, or a forex day trader, this information will help you leverage your trading account and hopefully help you earn more money consistently. The next topic that I'm going to go over, I'm very excited about. Usually I hold back on this topic, but today I'm going to demonstrate an asset that you can utilize to not only help you protect against adverse price move in the stock market, but can also offset some of your risk, diversify your account, and at the same time can help you increase your average profit per trade and decrease your percentage of losing trades. So there's lots of financial benefits to holding this one position in your account. And I'm going to name this asset and also show you several examples so you can see for yourself exactly how it works. And Gil from New Jersey writes, I'm glad I signed up for today's training class. Gil, thanks for the nice words, and I have lots to share with you today. This one topic is absolutely important and something that will help any retail investor or trader going forward, no matter what you trade or how you trade. Then I'm going to share with you a simple growth stock strategy that I tweaked and transformed into one of the most impressive stock income and growth strategies in my 22 years of trading financial markets and managing multiple hedge funds. This ridiculously simple tech and growth stock strategy generated or earned over 570% return in less than 6 years, using some of the most basic investment principles that would even make Warren Buffett proud. And today, I'm not only going to share this strategy, but I'm also going to show you some of the trades that were taken step by step. And finally, I'm going to show you how I took this simple stock strategy one step further and turbocharged it with one simple tweak. This one simple change boosted profits from an already impressive 570% to over 26,000% return in the same 6-year time period with only one single change, and made it into the single highest performing stock trading strategy that I've ever seen in my 22 years of professional trading. And tonight, I'm not only going to show you the strategy, but show you several examples of trades taken. Like I said earlier, I'm not going to hold anything back, and the knowledge that I'm going to share with you can be applied to the markets right away. Before I begin, I'd like to take a few minutes to tell you a little bit about myself. And I'll try to keep this to a minimum because I have so much actionable trading material to share with you today that I simply don't have the time for a long introduction. I was originally introduced to the financial markets in the early 90s. While I did attend law school and earned my law degree, I knew very early on that trading financial markets was my true calling in life. Once I graduated law school, I started a brokerage firm, and shortly thereafter I started 2 hedge funds that generated aggressive returns for the next decade. While my business was growing, I became increasingly involved in managing a large business with numerous employees and red tape. And gradually, over several years, my job went from doing what I loved to do, which was trading financial markets, to managing a large business and spending long hours away from my family. And that became a major source of stress and pressure on my growing family. And in fact, that was a major catalyst for a change. So I turned away from the hedge fund world and started educating traders from all over the world about 10 years ago. And that's how WealthPress began. And I can honestly say that it was the best decision that I've ever made. I get to enjoy time with my wife and 3 kids, and I also get to do the 2 things that I love to do the most, and that's trade financial markets and teach thousands of people from all over the world how to beat the financial markets. Okay, so now that you know the agenda for today and a little bit about my background, I have to go through the mandatory government disclaimer, which I highly recommend you read over. I'll leave it on the screen for a minute to give you a chance to read it while I highlight the most important parts. First, trading is speculative and there's a risk of loss. So start out real slow and use risk capital or paper trade till you completely understand the strategies and, more importantly, the propensity for the strategy. Second, when you use margin, you use leverage, which can increase your profit as well as your risk of loss. Everything works both ways. So always remember the upside as well as the downside to every trade that you enter. Lastly, no one can guarantee or foresee what the markets will do in the future. While we've done well in the past, there's never a guarantee that any strategy will perform well going into the future, as it did in the past. All we can do is use everything that's worked in the past to help us project and anticipate what will work in the future. But there's no guarantee. And if you're looking for guaranteed profits, then the only way you will get that is by putting your money into an interest-bearing account at a bank. As a general rule, the more profit you seek to gain from the markets, the higher risk you will take. While there are many ways we will show you how to improve your odds and decrease your risk of loss, we cannot guarantee profits. So please keep that in mind. Okay, so let's get to the fun stuff. I'm going to show you how technical trading strategies evolved over the past 40 years, how most retail traders are stuck in a time machine warp, continuing to utilize decade-old trading methods that have no edge in the markets and haven't for years. Originally, traders began utilizing technical trade methods on the commodities markets in the early 70s because these markets trended exceedingly well. The stock market had virtually no volatility at the time, and we'll get into stocks and the stock market in a bit, but I have to give you some background first. So a few opportunistic traders began trading the 20-day and 50-day price breakouts, which is simply buying after price reaches the 20 to 50-day price high by a few ticks. In this example, you can see a typical 50-day breakout applied to the markets. It's a very simple trading method, and because computers were not around or available to the general public, it was simple for traders to keep notes of the daily highs and lows over the extended periods of time and use this data to figure out breakout levels. This method, with a few simple tweaks, was used successfully for close to a decade, till the early 80s, when the commodities and currencies became more liquid and numerous traders began applying the exact same tactics to the exact same markets. Moreover, commodities did not trend as well in the 80s as they did in the 70s, and trends did not sustain themselves as long. As a result, both the 20 and 50-day breakouts started to deteriorate, and slowly professional traders shifted to a different method of analysis. In this example, you can see the oil and gas ETF, which tracks the energy markets. And you can see that every time the asset hits a 50-day price high, it backs away and takes a nosedive, which demonstrates how price tends to pull away from the 20 and 50-day breakouts, which is the opposite of what we saw in the 70s. By this time, and now we're in the mid to late 80s, commodities and futures trading became increasingly popular. So it attracted many traders with mathematical backgrounds. And at the same time, personal computers were becoming accessible to the general public. And the combination of mathematics and computers entering the trading world gave popularity to technical indicators. Now, keep in mind as I go through all of this, the stock market in the 80s was still considered by the general public as an investment vehicle. No one was day trading or swing trading in the 80s. This did not start till the 90s. So all the indicators, the moving average, the stochastics, the RSI, the MACD, all of these indicators were created and designed for the commodities, futures, and currencies market, decades before online brokers were ever invented, and when the typical stock fluctuated about 25 cents per day on average. This was decades before high-flying stocks like Amazon and Google were ever around. So all of these popular indicators that traders swear by were never created, tested, or traded with stocks in mind. More importantly, and this is a real biggie, most professional traders never utilized these indicators for entry and exit, and restricted them to either market sentiment or trend analysis, while the retail trader, more often than not, began using these indicators as entry and exit signals. And that caused major problems because the majority of technical indicators are lagging indicators. And that means they trail behind price and not ahead of it. To give you a good analogy, imagine driving a car while looking at the rear view mirror. If you did that, you would crash immediately and your car would turn into a big wreck. And unfortunately, the great majority of traders who use technical indicators for entry and exit end up turning their account into a big wreck the exact same way. And the reason is really simple. Technical indicators are simply math formulas that use price to generate signals. Without price, these indicators have no way to give us the signal, and there's a delay between the time price is generated and the signal is generated, which means you're getting your entry and exit signal after the fact, which is exactly the same as driving your car while looking at the rear view mirror. And the results to your trading account can be devastating. Now, I want to clarify that technical indicators can serve a very important purpose. For example, I use technical indicators when I'm trying to figure out if the overall market is overbought or oversold. And other indicators are great for determining whether or not the market is trending or not. But to use technical indicators for entry and exit specifically is something that was popularized in the 80s and for the most part has very little forecasting value. And we have a comment from Frank from New York who says this makes a whole lot of sense and is truly eye-opening. Thanks, Frank, and I have some very cool tactics coming up that you can add to your trading toolbox. So make sure that you stay till the end of the training. So getting back to the topic. Before the mid-90s, only pro traders and fund managers had access to custom-made statistical analysis software that costed hundreds of thousands of dollars to write that would allow them to test strategies. But by the mid to late 90s, computer power became relatively cheap, and software that was written specifically for backtesting strategies became widely available for the retail trader, giving the retail trader the power and ability to write a few lines of code and press the enter button, and within a few minutes see for themselves that the great majority of technical indicators simply did not work nearly as well as they had previously thought they would, especially when applied to the stock market, which these indicators were never designed or created for in the first place. By the early to mid-90s, however, the stock market began to gain real value, and with more value came higher volatility levels. And at the same time, the internet exploded, and traders began using online stockbrokers. And almost overnight, all the trading analysis tools that were originally designed for the commodity futures and currency markets became applicable to the stock market. The obvious problem with all of this was the fact that none of these analysis tools were ever designed for, tested, or proven to work with individual stocks. But that didn't stop millions of traders from applying the exact same tactics to the stock market, with the presumption that the same tools that worked for commodities and currencies will in fact work with stocks. The problem with this thought process is the fact that commodities, futures, and currencies tend to trend much better over time than stocks. And the reason why that occurs is rather simple. There's simply not enough information coming out on a daily basis about individual stocks to cause them to trend daily over time. With the bond market, or the US dollar, or the corn market, for example, there's a constant stream of information that influences price. Whether it's the weather or global uncertainties, there's a constant stream of data that goes on. But with stocks, aside from quarterly earnings, upgrades and downgrades, there's just not enough data to create constant directional movement. And therefore, many of the indicators that are designed and successfully work with forex, commodities, and futures don't necessarily apply or work nearly as well with stocks for the exact reason that I explained. Now, don't get discouraged, because in just a bit I'm going to explain the exact methods that work extremely well with stocks. But for now, I just need you to understand that most technical indicators that are used to enter and exit stocks were never designed, created, and utilized successfully for stock trading, because the stock market is predominantly a counter-trend market, while the commodity and currency market is predominantly a trending market. And indicators that work well for derivatives, currencies, and commodity markets do not always work as well with stocks for that exact reason. There's no mystery to this. This is something that hedge fund managers and pro traders know well. What we did find over the past 20 years was the fact that stocks respond amazingly well to price analysis, and not just isolated price analysis, but relative or comparative analysis. This method of analysis involves comparing numerous assets to see which one is the strongest or the weakest one in relationship to all other assets that are tested. In other words, we don't compare the asset against the indicator, which is essentially comparing price against itself. But in this scenario, we're comparing one stock's performance against several others to see which one outperforms all others. If you think about it logically, if you want to see which horse is the fastest, you don't compare it against itself, but you compare it against other horses. And when you want to determine which car is the quickest, you compete against several others, which is the only logical way to determine or pick the winner. And this exact same method applies extremely well to the stock market. So instead of looking at individual stocks to determine which one we're going to buy or sell, we instead look at a group of stocks to help us determine our next step. Let me give you a good example of relative strength analysis. Let's assume we wanted to determine the strongest stock out of a group of 4 stocks over a 2-month period of time. We would simply determine the percentage increase in price for each stock over that time period, and the one with the highest percentage gain will have the highest relative strength. It's really that simple and doesn't require a major learning curve to figure out. In this particular example, stock D gained 25% and clearly has the biggest percentage increase out of the group, and therefore stock D has the highest relative strength over a 2-month period of time. Tim from Cleveland asks why we don't look at relative strength or relative analysis for commodities and currencies. And Tim, that's a great question, and the answer is simple. There are only a handful of commodities and currencies, and each one is unique and has a specific focus, which is why it's called a commodity. Most commodities or currencies are so unique that it's very difficult to compare them against each other. But with thousands of different stocks, you look at stocks comparatively instead of individually, and you get to see which stocks are being accumulated more than others over time, which is hard or impossible to do with commodities. For example, what are you going to compare orange juice to? Compared to lemon juice or Canadian dollar? You can't compare it to anything. It's unique, so you're forced to look at it in isolation, which is what you do when you apply technical indicators. You're looking at each asset individually. But with relative strength, you're comparing a large group of candidates to see which one is the strongest or weakest in the group. And not only does this type of analysis work with the stock market because there's so many stocks, but it also makes a whole lot of sense because over time, institutions and mutual funds tend to accumulate the strongest and the best stocks and liquidate the weakest ones. So the strongest stocks float to the top and the weakest stocks sink to the bottom. And using comparative strength analysis allows you to catch these stocks as they're moving both up and down. And I hope I was able to answer your question, Tim. And thanks for participating in today's class. Aside from relative strength, another major development or evolution that hasn't caught on with the retail trader in the past 2 decades has to do with volatility or trading range. Specifically, the typical retail trader pays attention to whether price moves up or down, but rarely focuses on the quality of the trading range or how the price moves from one price level to the other. To give you an example, take a look at the chart of Amazon. Notice that price is rising steadily, and even when it increases for a few days, it then reverts back down to the lower end of the range. So over a week or 2 period, volatility moves back and forth, but it's within the same range, more or less over time, if you were to look at the average. If the daily trading range continues to stay near the same price level, the odds that the trend will continue moving in the same direction is much, much stronger than if volatility begins increasing over time without coming back down to its average daily volatility level or range. Take a look at this example. This is a chart of QQQ, which represents the top 100 NASDAQ stocks. And you can see how the daily trading range starts out near the 50 cent to $1 daily range. And over time, as the trend continues, the volatility levels increase substantially. This also means that the odds of the trend continuing is greatly diminished, because when volatility levels increase substantially, it means there's a much higher level of uncertainty entering that particular asset. To put in other words, it means that buyers are being challenged by sellers at that price level, while at a lower price level, the trading action was predominantly one-sided. Otherwise, volatility increases. So what you want to do when analyzing price action is always take into consideration where price range began increasing substantially. Even if price continues moving higher, it still means that sellers began coming into the stock near the price where volatility began increasing, which tells you that the stock is getting close to topping out or reversing, and that price is now trading above fair value. And this is something professional traders realized and picked up over 20 years ago. And it's not something retail traders ever take into consideration. And guess what? This information is about 50 times more valuable than the majority of technical indicators. And the great majority of retail traders pay absolutely no attention to volatility levels and how they influence price. Jason from Ohio says, "This is the most valuable trading information. I can't believe it's been in front of me all of this time." Thank you, Jason. Thanks so much for the nice words. So before I move on to the next section, I'd like to summarize what I went over. I don't want to get ahead of myself, which I have a propensity of doing at times. So over the past 40 years, there have been numerous changes in how pro traders or institutional traders analyze market action in comparison to the retail trader or the average guy with a small to medium-sized account. First, the majority of technical indicators out there were created for the futures or currencies market because these assets naturally trend due to a wealth of fundamental information available to traders on a daily basis, while individual stocks have less information available outside of earnings, takeovers, upgrades, or downgrades. And while technical indicators work very well for overall trend analysis, I'll repeat that once again. Technical indicators work very well for overall analysis. For the most part, they don't work well for entry and exit, which is how most traders who trade stocks utilize these indicators. On the other hand, stocks do respond well to relative strength analysis because there's so many individual stocks to choose from, and large financial institutions pick out the strongest stocks in favor of weaker stocks, which cause the strongest stocks to rise and outperform all others. Similar to Darwin theory, survival of the fittest, if you will. I then explained that one of the most important factors that institutional and pro traders pay close attention to and retail traders ignore for the most part is the quality or the volatility or the trading range. If the stock is trending and volatility levels are staying constant or increasing slightly, the odds of further increase or decrease in price is probable. If, on the other hand, volatility levels are increasing substantially and anything over 2 times the average daily range is substantial, the odds that price will continue moving higher is greatly diminished. It doesn't mean that price is going to reverse. It means that price may simply consolidate and stay range-bound for an extended period of time. I want to be clear on that point, but it does mean that the trend, either up or down, is going to come to an end or pause over the next few weeks, and sometimes even quicker. And we have a question from Peter from Ontario, who's asking what time frame we use to measure volatility. Peter, that's a good question. We typically look at stocks' average daily range over the past 2 weeks. So we identify the period when the stock began trending and then wait for volatility to double. You can simply look at the trend and see volatility is increasing substantially. And the more volatility increases, the quicker the stock will begin looking for consolidation or pullback in the trend. And I hope I was able to answer your question. And as far as the actual increase in volatility or trading range, I take notice or begin paying attention when volatility levels increase twice the average daily range. So you want to pay attention to stocks during the first week or two of the trend. If the stock was fluctuating $2 per day, for example, and all of a sudden it begins to fluctuate close to $4 per day, that's a red flag. So you want to take the average volatility and see if it increases by 100%. And that's the level that you want to think about getting out of the trade. Since 100% increase in the daily trading range is a warning sign or a red flag. And that's something we take into account when building trading strategies and systems. The next important topic that I'd like to cover or point out is the biggest difference that separates the multi-billion dollar institutional trader and the retail trader. I think this is a very important topic, and once you understand this topic, I think you'll start looking at the financial markets from a slightly different perspective. At least that's what I've been told by my students who have previously learned what I'm about to teach you right now. The average trader, or the retail trader, for some reason or another, equates successful or profitable trading with hitting home runs. I'm not sure if it's something traders envisioned when they first started out or something they picked up along the way, or if it's that first experience of buying stocks and seeing them run up several dollars that gets the retail trader excited. I can tell you from personal experience, talking with traders on a daily basis, that most traders always remember that big win. The truth of the matter is that real money in the markets is almost never made by individual positions, at least not by pro traders. And let me explain to you why, so it makes sense to you. There's this inconvenient mathematical principle that applies to trading, and it's called risk of ruin. In simple terms, what it tells you is that if you risk over a certain percentage on any one trade, the chance of ruining your account or going bust is a certainty. So when you hear traders talk about leveraging the entire account on any one trade, you should seriously consider running the other way as fast as possible. Because according to mathematical principles, which no one can escape, it's almost impossible not to go broke if you risk more than 5% of your account on any one trade. The typical acceptable amount is 2%, and hedge funds typically go to about half of 1%. So diversifying or avoiding concentrated positions is not a choice, it's a necessity. Otherwise, the chance of going broke is a certainty, and fund managers never want to be in that position. So instead of focusing on individual position growth, the institutional trader or the pro trader will focus on clusters or small combination of positions that are designed to work together in the current market environment. You must have heard of the term computerized buy and sell programs. Well, these programs don't buy individual stocks or sell individual stocks. They sell a basket of stocks or a bundle of stocks at the same time. This way, the fund is always creating a perfect mix between stocks or other assets in light of the current market conditions. And what this does is create the perfect exposure for the current market environment. For example, if the defensive stocks are rising, the trader may initiate positions in a few different defensive sectors to spread the risk and diversify as much as possible. And that will keep the risk of ruin down to an absolute minimum. If, on the other hand, the market is rising quickly, the trader may increase exposure in highly speculative stocks and decrease exposure in defensive stocks. So every trade is like a cocktail that's perfectly mixed for the current market environment. So the pro trader never focuses on that one individual trade. As a matter of fact, if the profit on one trade is out of line with other trades, there's a major problem because the trade could have gone the other way and the loss could have been bigger as well. So it's very important for the fund manager to focus on maximizing growth for the overall account and minimizing risk for the overall account as well. And the last thing the pro trader or the fund manager is interested in is hitting home runs or finding the next stock that's going to make 10 times the return. Because it's much, much harder to find the next Amazon or the next Google stock than to consistently and predictably leverage account growth by using position clusters or bundles that are specifically targeted and take into consideration the current market volatility level, sector strength and weakness, relative strength, and dozens of other factors that will help the trader get the most profit under the current market environment. And that's the key. Let me give you a good analogy. if you've ever seen or heard of people who know how to count cards when playing blackjack against a house, the goal is not to count cards to figure out what cards will come next. The goal is to select the best cards under the circumstances at any given time. And over time, and that's the key here, over time, the player ultimately picks cards that are better than the house. And position clusters work much the same way. They allow you to pick the best combination of stocks with the most resilience under the current market conditions. And if you can consistently stay in clusters that are stronger than the overall market, then over time, the trader will outperform the market, which makes complete sense and happens to be the same way pro traders make money from the markets on a consistent basis over time. And Kevin from Washington says that he's amazed at what he's learning. And he's been trading for over 15 years. Kevin, I'm just getting warmed up, and there's much more to come as we get deeper into all of this. So let me show you a very simple example of a trading cluster. And the cluster was held for 2 weeks or 10 trading sessions. And the cluster consisted of 3 positions. You can see the entry of each position in the cluster and the exit as well. Notice that 2 out of 3 stocks gained and offset the loss on the other position. This particular cluster had a profit of almost $29,000 over the 10-day holding period. Once again, when we put together these types of clusters, all we're doing is combining 2 or 3 different stocks that we anticipate will work well together over the next few weeks. And our goal is to profit from the overall cluster as a whole, instead of focusing or fixating on how much each individual stock will gain or lose. The cluster can include a combination of defensive and aggressive stocks, or multiple defensive stocks. Or if the market is just starting to trend, the cluster can include more speculative stocks. But one way or another, this is how large banks, institutional traders, and pro traders initiate and offset positions to maximize account growth, instead of focusing on finding that one stock that's going to give them that big home run. In this example, you can see another example of a stock cluster, and you can see once again how 2 out of 3 positions decreased or lost value, and 1 gained money. But overall, the entire cluster gained slightly over $3,000 over the 10-day holding period. And that's the ultimate goal, because you increase diversification, which decreases risk, and that causes you to grow your overall account quicker. And the less time you spend recovering from a loss, the quicker your account will increase in equity gains. And that's the ultimate goal. Another major advantage of trading multiple positions using clusters instead of individual positions involves volatility as well. If, for example, volatility levels are higher in the overall market, the trader can select stocks that are not participating as much or have lower volatility levels for the next 2 weeks. Or conversely, if the overall market is consolidating or trading in a range-bound pattern and is doing very little, we may select more aggressive stocks that have higher level of historic volatility, because these stocks will outperform the market during stagnant periods of time. So position clusters allow you to focus on the overall account volatility, which is a significant factor that determines how fast your overall account grows. Notice how everything we talk about circles back to the overall account instead of finding that one hidden stock that's going to skyrocket. As I said previously, that type of mentality is for highly speculative traders who are looking for those rare home runs. These are great, and I'll show you how to capture almost every one of them a bit later. But for now, I want you to begin thinking a little bit differently and start looking at the market from a perspective of overall account growth and how the market impacts the overall account instead of being obsessed with how to find the next big winner. And Gabriel from Miami is asking whether we can apply these principles to small trading account, or do we need to have a large account to trade this way? And that's a great question, Gabriel. And because we're trading stocks instead of currencies or futures contracts, we can fine-tune these strategies to work very well with small trading accounts for traders who are just starting out. If we were trading, and I repeat, if we were trading fixed-sized contracts, such as futures or currencies or commodities, then we would have trouble doing this. But because we're trading stocks, we don't have this problem. So yes, you can trade a combination of a few stocks without being restricted by a small account. And as I mentioned previously, it's actually less risky to hold a basket or a bundle of a few stocks than to leverage everything on one position, because ultimately we don't know what will happen. So preservation of capital has to be our first concern, and diversification is one of the best and proven methods of decreasing risk substantially. But there's more to all of this. I actually gave you only part of the puzzle. I didn't want to give you everything before you understood the concepts of bundles or baskets, instead of finding stocks that are going to multiply 10 times in value, which does happen, but not frequently enough to create consistent income or consistent growth from your trading account. So if you recall, when I first began, I promised you that I would demonstrate an asset that you can utilize to not only help you protect against adverse price movement in the stock market or offset some of your risk, but you can also use this asset to diversify your account. And at the same time, this one asset will help you increase your average profit per trade and decrease your percentage of losing trades. So there's a lot of financial benefits to holding this one asset in your account or as part of the bundle or the basket of stocks. Before we identify this asset, I'd like to show you two graphs. These are two assets that are completely unrelated to each other. In other words, they have no direct relationship. The graph represents the exact same time frame, down to the exact date, and you can see that when one gains value, the other one loses value. The first chart is the S&P 500 during the second half of 2008, and the second chart is the long bond, not the actual futures contract, but an ETF, which stands for Exchange Traded Funds, which trades exactly like a stock, utilizing shares. But it follows the long bond, almost tick for tick, or tracks the long bond the same way the SPY ETF tracks the S&P 500 futures contract. I specifically wanted to use the second part of 2008 because it demonstrates an environment when stocks are quickly losing value. In the old days, if you wanted to buy or sell the entire stock market in one shot, you would have to learn about futures contracts, and these contracts were fixed size. So you couldn't buy shares. You had to buy or sell a fixed sized contract, and that caused the retail trader to avoid trading broad market assets. But ETFs leveled the playing field by allowing traders to trade any type of financial, currency, or commodity contract using stock shares, and moreover, not having to deal with fixed-sized contracts. At the present time, you have hundreds of different ETFs that target just about any type of financial market, and finally, allow the retail trader to trade the same assets as the large institutional trader or hedge fund. The ETF that I'm demonstrating tracks the 30-year long bond. And to keep things really simple, historically, when stocks begin selling off or trading lower, investors and hedge funds begin liquidating stocks and rotating assets into fixed income. You might have heard the term flight to quality, which is another way of stating that traders seek fixed income and safety when equity markets are selling off. Keep in mind, I'm not reinventing the wheel here. This is part of solid economic principles that have been around for several decades. The only difference, and what I'm adding to all of this, is a way for the retail trader to take advantage. Until ETFs were around, there was no way to do so. To give you a really good example, take a look at the 30-year bond, the actual futures contract. That's the chart on the right, and compare it to the chart of the TLT ETF. That's the chart on the left. This is a one-year price chart using the same time frame. Notice that they're virtually one and the same and mimic each other's movement. In my 22 years of professional trading experience, I have yet to meet one fund manager or professional trader that consistently makes money from the markets that does not utilize the long bond in their portfolio. But most retail traders don't even know that there's a highly liquid asset that they can add to their account to naturally hedge against stock market corrective action, and the fact that it's IRA friendly and doesn't require you to trade inverse assets of any kind to protect yourself. So now let's get to the fun stuff. I'm going to show you how adding the long bond to our position can help us increase our profits and decrease our risk at the same time. And Jason from Montana says, this is the best trading class I've ever attended, and I've been to dozens of different ones. Thanks for the heavy-duty hedge fund tactics. Jason, I promised you in the beginning that I wasn't going to hold anything back and show you everything, and that's exactly what I'm doing. And there's lots more to come. So I'm going to put everything together for you and show you some amazing ways to increase your profits with very little work on your part. And thanks for the nice words. We do appreciate it. And we have a question from Don, who's in Atlanta. And Don is asking if we rotate between the equity or stock bundles or clusters and the bond position, or whether we add the bond position to the cluster. And Don, that's a great question. And what we do is add the bond position to the cluster or the bundle. And once again, I use the term bundle and cluster interchangeably. They really mean the same thing. I first wanted to familiarize you with bundles or clusters and then introduce the long bond so you would understand how it all fits into all of this. And now I'm going to show you several actual examples of trades that consisted of clusters so you can see how it all works together and how the bond position helps increase profits and decrease risk at the same time. And keep in mind, Don, the examples that I'm going to show you were held for 2 weeks and sometimes for the entire month, but rarely more than that. So this approach works well whether you're an active trader or an investor who only wants to capture price swings that last a few weeks to a month at the most. This is an example of a trade cluster that was entered on 11/28/2014. The cluster involved Apple stock, Dollar Tree stock, and Costco stock, all representing 80% of the cluster, while the long bond represented the remaining 20% of the account. You can see the bond position highlighted in yellow. The position was held for only 2 weeks. You can see how 2 out of 3 stocks increased in value and one of the stocks lost money, but the bond gained as well. Before we entered this cluster, the market rallied for some time, and our analysis told us that stocks were going to begin seeing mild corrective pressure. Prior to this rotation, or this bundle, we actually held 30% in each stock. But with the stock market softening up a bit, we decreased the exposure in the stocks from 30% each to 25% each, and increased our position in bonds from 10% to 25%. Notice how our focus is shifting from gaining the most profit on each stock to maximizing overall account growth and protecting our equity, which is the focus of professional traders, not finding the next Amazon or the next Google. And if you utilize relative strength, then it's impossible not to catch these stocks because they'll begin gaining relative strength at the expense of other stocks. So catching them is not hard, but maximizing your overall equity or your account growth is the key, because at the end of the day, you ultimately care about your account getting bigger, and that has to be the ultimate goal, to maximize your account growth and to leverage your overall account at any given time, just like a pro trader would. Now let's go through another example. I want you to understand how these bundles or clusters work and how combining just a few stocks and a long bond ETF can make a huge difference to your bottom line. Once again, we held this bundle for 2 weeks. And in this scenario, we held eBay stock, Netflix stock, and Sirius stock. And once again, long bond ETF. And I wanted to show you an example where the long bond really helps the position out. Notice during this 2-week cycle, the stock market really tanked. But because we had 50% of our exposure in the long bond, investors dumped stocks and bought bonds. And that helped us offset our risk and come out ahead instead of dig ourselves out of a 2-week losing period, which means it's going to take the overall account additional time and work to come out ahead. So once again, we are focused on overall account growth and how the loss impacts the overall trading account. I'll do one last example before moving on, because I want to build on top of this, and I want to make sure you understand the concepts of trading 2-week clusters and including bonds in the cluster. So this cluster was initiated during the last 2 weeks of 2015 and lasted 2 weeks, the usual or the typical length we hold each cluster or bundle. The cluster included 80% stocks, and you can see in this capsule the stocks and all other details, and 20% of the cluster was held in long bonds. It's highlighted for you. And once again, you can see how the entire 4-position cluster did over the 2-week period, and how the bond market helped increase the gains and offset some of the risk on the trade. And because we include 3 different stocks in this cluster, we adjust the aggressiveness of our exposure to stocks or bonds based on how much we allocate to each stock. So for example, if we're defensive, we may allocate only 15 to 20% to each of the 3 stocks and a whopping 45 or 50% to the long bond. In this case, we're expecting the stock market to stay range-bound or begin correcting in the near term. We don't just set an arbitrary or the same exposure at 30% or 20% or 10%. Each bundle or each 4-asset position that we initiate is based specifically on the current market environment, the volatility level, correlation, relative strength, and other factors that help determine our exposure. So instead of trying to figure out which stock is going to make us rich, we begin focusing on maximizing the overall account growth. And down the line, that's what's going to help you retire. Overall account growth. Not finding that one stock that's going to increase in price 10 times. That's not where the big money is made in this business. It's made methodically over time using very limited risk techniques that give you an advantage without wiping out large gains. And these methods that I'm showing you do not require a large account and provide a built-in hedge in every position that you initiate. While today's class is focused on growth stocks and tech stocks, you should know that what I'm teaching you today is not based on theory. For example, one of our follow-along programs is an ETF program that only trades ETFs. It's called the Market Cycle Program, and it utilizes the long bond to offset risk and help increase gains. While this program doesn't use stocks like the examples that I showed you, instead they just use ETFs, such as the SPY ETF, which follows the S&P 500 and a few others. But the way we offset risk and create bigger gains in this program is by using the long bond, exactly the same way I demonstrated to you in the last few examples. This is the graph of the Market Cycle Program. It's up almost 900% in less than 6 years. And I can honestly say that if we did not have the long bond in the portfolio, the performance would be less than half of that. So when I tell you about including the long bond in your portfolio, I'm not just talking about some theoretic principle that may or may not help you increase your profits. I'm telling you that this asset will help decrease risk, increase diversification, and as a result, your account will increase gains over time. And that's the big key to success in trading: overall account growth. Hedge fund managers don't brag about finding the next big stock to triple in price. They brag about consistent annual returns and minimal risk. That's how real wealth grows over time. Before I move ahead, I'd like to put everything together for you and summarize the key points that I want you to take away from what I covered so far. And I'm hoping that you're taking this material very seriously. Everything that I'm explaining and teaching you is based on solid and very grounded economic principles. So we began with evolution of trading principles and how the great majority of indicators and analysis tools that traders apply to stocks were never created, designed, built, or tested on stocks. Because when these indicators were invented or created, stocks did not have nearly enough volatility to make viable trading assets for active traders. I further explained that relative strength is the best way to determine which stock is outperforming the overall market, and the odds are strong that it'll continue to outperform the overall market. When stocks are outperforming the market, it means funds are accumulating that stock more than other stocks, and that ensures that the stock will remain strong and continue gaining strength. I then shifted focus to volatility and explained how major spikes in volatility precede change in the trend. This means when daily trading range increases 2 times the daily average trading range, the odds are strong that the stock will cease trending and either reverse or enter a range-bound consolidation cycle in the next few weeks, and possibly sooner. Most retail traders believe that rise in volatility means stocks will move more, but statistically, sharp rise in volatility means the opposite. Then I jumped into maximizing overall account growth by using bundles instead of individual positions, and how adding the long bond to each bundle can help you fine-tune your exposure to the current stock market action. If the market becomes defensive, we would increase the bond position and decrease the concentration of equities in the bundle. And if the stock market was bullish, we would decrease the percentage of the bond position and increase our exposure in the 3 equities that we hold to maximize profit and minimize risk on every trade that we initiate. And Carrie from Arizona is asking if we ever include short stock positions in each of these bundles, or are all stock positions long? Carrie, that's a good question. And to answer your question, we don't trade short stock positions in these bundles because we include the long bond. If we didn't include the long bond, then I would have to consider shorting stocks or including futures bond contracts, which is what fund managers did for 40 years before ETFs were around. But now the retail trader has the same advantage as the pro trader and can fine-tune his entire account using bundles and include the bond ETF even if they have a tiny account, which really levels the playing field between the retail trader with a $5,000 or $10,000 account and the hedge fund trader who's trading a $500 million account. And I hope I was able to answer your question, Carrie. So moving ahead, a few years ago, several of the traders in my ETF program asked me if the same relative strength methodology or the same approach that I applied to ETF programs could be adapted to individual stocks. For those of you who are just starting out, ETFs are great, but ETF is created by putting together numerous stocks, sometimes as many as 500 stocks. And when you combine so many stocks, it limits the gains and the losses, which is one of the advantages of trading the entire index. But take a look at the trading action of the S&P over a 6-month period of time. The index gained slightly less than 2.5%, actually 2.41% to be exact, which is a fairly significant period of time in my opinion. Now take a look at Amazon stock. During 1 month, this stock gained a whopping 34.88%, almost 32.5% higher than the index. So when you trade one or two or even three stocks instead of trading the entire index, your gains could be substantially bigger. And when I say substantially bigger, I'm not just giving you some theoretical number. These type of returns are simply not possible in a 1 month time period when you're trading the stock index, which is what we use in the ETF program when the stock market is moving higher. So a few years ago, I decided to start applying the exact same approach that I just outlined for you to individual growth and tech stocks, not some small speculative penny stocks or cheap stocks, but instead to the highest performing NASDAQ stocks, the Apples, the Amazons, the Googles, and stocks similar to the ones I'm describing. And keep in mind, as I go through this, that these stocks are extremely liquid, so they make amazing candidates for options traders, and I'll get into that in just a bit. So, in a nutshell, I utilized the same defensive approach that I had used in my ETF program, which is the bond ETF. And for growth, I used 3 of the strongest growth stocks at any given time. And I picked these stocks using the exact same relative strength method that I explained earlier today. And this is the performance of the account that was started with just $10,000. And the most important part of all, the profits from each 2-week trading cycle were never reinvested back into the system. In other words, this is how much $10,000 account continued to generate over the entire 6-year period. And the methodology returned over 570% return. And once again, this is not reinvesting profits, but taking profits out every 2 weeks and only trading with $10,000. If you were trading options, your profits would have been substantially higher since options give you leverage. But options aside, with just the right concentration or combination of 3 of the fastest growing stocks and 1 bond ETF to offset risk based on the current market environment, we were able to achieve a staggering 570% return in less than 6 years. And if you have not figured it out yet, the cluster examples that I had demonstrated just a bit earlier were actual trades that were taken from this strategy. And I'm going to walk you through several more right now, complete with the bond ETF, so you can see the combination of stocks with bonds and how the complete cluster plays out over a 2-week period, which is how long each rotation lasts in this program. You buy at the beginning of the month and then you rotate into another position when the month is halfway over. In other words, you rotate into a different cluster every 2 weeks. There's no micromanagement involved during the trading day or adjustments of any kind. You simply adjust your clusters or your positions every 2 weeks in the beginning and middle of the month. So this methodology is ideal for traders who don't have time or choose not to sit in front of the trading screen all day. This is not day trading or trying to pick the daily highs and lows. We give the combined position or cluster 2 weeks to work out in our favor. In this example, you can see a complete 2-week trade cluster. This one includes 3 stocks, which is the usual mix, and a bond position. And as I mentioned previously, the only thing that changes every 2 weeks is the 3 stocks, which are rotated, and the allocation between the 4 assets, the 3 stocks and the bond ETF. Notice how individually not every asset generated an overwhelming profit, but when you combine all 4 assets together, the gains add up. Notice that each stock in the cluster is a large cap stock, and I can assure you that during the time we initiated the trade or selected the stocks for this particular cluster or bundle, each stock that we selected was outperforming all other stocks at the time. The standout performer in this particular cluster was Applied Material, one of the biggest semiconductor stocks which gained over 8% in just 2 weeks. But we're less concerned with the profit of the individual stock and are more concerned with the profit or the gain of the overall cluster instead. And Peter from Chicago is asking if we ever hold on to the same cluster for more than 2 weeks, and if we always allocate each cluster the same way proportionately. Peter, that's a great question, and let me clarify this for you. Each cluster is held for 2 weeks, and sometimes, not often, but sometimes, we may end up holding one of the 3 stocks for an additional rotation if that stock continues to outperform the overall market or continues to gain relative strength. So if the stock continues to fit our criteria, then we stay with that stock. But that doesn't happen very often. And the great majority of the time, we end up rotating the entire cluster. To answer your second question, each cluster can vary from no bonds and allocating to equities equaling 33% each, which would occur if the stock market is going through a very strong bull run and is also breaking out across the board, and large cap stocks are rising strongly. That's one extreme. And the other extreme would be a cluster that has 50% bond position and 50% in defensive equities. And that would occur during a period when stocks are seeing strong selling pressure, and the bond position would offset the loss, and more often than not, increase profits at the same time. In the position that you're seeing at this time, the allocation to the bond position equals about 10%, and the rest of the position is allocated to stocks. So at this time, the model believed that the stock market was relatively bullish. Otherwise, it would hold a larger concentration in bonds and less allocation in stocks. And I hope that answers your question, Peter. In this example from September of 2016, we allocate 25% to bonds and 25% to each of the 3 stocks in our cluster. Yes, there's a big winner in this group, and yes, Amazon gained 7.34% in just 2 weeks, and we caught the whole thing. And yes, you will catch all the big gains, because in order for stocks to become big gainers, they have to outperform the majority of stocks that are being traded. And that's exactly what this method looks for. So it catches the Amazons, the Teslas, and all the big cap growth stocks that you hear and see on CNBC all day. But more importantly, I wanted to show you this example because of the allocation. If we allocated 25% to the bond market, then the model believed that the stock market was going to be predominantly choppy over the next 2 weeks. If the model believed that the stock market was going to be extremely bullish, then the concentration of the bond position would be reduced or completely eliminated. But the fact that we had 25% bond position in the portfolio told us that the market was going to be moving back and forth or staying choppy. And that's exactly what happened. And all 4 assets, including the bond positions, profited over the 2-week period. So once again, this position was held for 2 weeks, and the model fine-tuned the exposure to give the correct balance to all 4 assets that made up the cluster in this particular case. And that's the goal, to create the perfect cluster based on the current market environment and keep adjusting and rotating into stocks that fit our criteria and allocate based on the overall volatility and market balance, which is all determined by price, volatility, and correlation. Here's an example of another cluster, and this cluster does not include a bond position because the model interpreted that the stock market was extremely bullish. So the model only held 3 stocks, and only 2 stocks made money during the 2-week cycle. Once again, the cluster has a standout winner, which was Tesla stock, which outperformed the other 2 stocks and gained a whopping 24.28% in only 2 weeks. And the strong gain on Tesla more than offset the loss on the losing stock, as you can see by the cumulative profit of the bundle during the 2-week holding period. Keep in mind that each cluster is tuned specifically for the next 2-week time period and designed for the current market environment, not based on what already happened, but on the current volatility level, relative strength, and correlation levels. If you look at this particular cluster, you will see that the stock portion of the cluster didn't perform so well, but the bond position really saved the day and added substantially to the bottom line. So the bond position doesn't just help you offset risk or reduce risk, but the point of including it is to leverage every part of the trading account and actually use it to maximize your gains, which is exactly what we did in this cluster, as you can see in this example. If the cluster did not include a bond position, the profit would have been mediocre. But by including the bond position within the cluster, the 2-week cycle ended up being a good-sized winner. And keep in mind, we're not using 10 or 20 or 30 different stocks and bonds. We're simply blending 3 stocks or 3 stocks and 1 bond position. So it's really simple, and we only rotate twice per month. So you can trade this type of strategy regardless of your schedule, since it doesn't require any micromanagement. And Ed from Las Vegas is asking if we use stock volume or any technical indicators at all in figuring out what goes into the cluster. And Ed, to answer your question, we're relying on very basic principles, such as relative strength, which is like picking the strongest horse in the race, volatility, and correlation. And that's the reason we're able to achieve such strong gains. And I was actually just about to get into this in more detail. So Ed, your timing is perfect. I want you to step back for a minute and remind you that our method is based on very solid trading principles, buying stocks near 52-week highs, using relative strength to determine which stock is outperforming the market, hedging with bonds, continuously monitoring volatility and correlation, all the hallmarks of basic investing 101. No tricks, just turbocharging basic principles that have worked for years and will continue to work. No mysterious patterns, no complex waves, no black box systems, no lagging indicators that point out or reflect what already happened. And that's what I truly love about this methodology. It takes the most basic trading principles and maximizes them or transforms them into a world-class trading strategy that consistently outperforms the market and doesn't require you to stare at your computer or your smartphone all day. Remember, a short while ago, I showed you a chart of the performance of this strategy. And this is a graph of the performance over the past 6 years. And we didn't reinvest any profit back into the strategy. We simply allocated $10,000 to each trade cluster and held it for 2 weeks. And then whether we made money or lost money, we would simply reinvest $10,000 once again. And over this time period, the strategy generated almost $60,000 net profit, which is almost 600%. And that's amazing performance. But let me show you what happens when I make just one minor adjustment. And what I did was apply a very basic principle called bet sizing. And what I did was simply reinvest all profit from every trade back into the strategy over the entire 6-year period. And while I'm going through this, I want you to keep in mind that I did not change any of the trades or the allocation of the trades. In other words, all entries and all exits were identical between the two accounts. Only difference was in one account, we invested $10,000 for each and every trade. And in the other account, we reinvested all profits back into the account for every trade. And this is the graph of the turbocharged system. And you're not seeing things and your monitor is not out of focus. The same exact strategy generated over 26,000% return in just 6 short years. So instead of allocating $10,000 and taking out profits after each trade, We simply reinvested the entire account equity into each and every trade. But the trades were identical and nothing was changed. And that, my friends, is the power of position sizing or bet sizing. And we were able to take a high performance strategy and turbocharge it into the single best performing strategy that I've ever seen created or traded in my entire trading career. And today, I'd like to introduce you to the Momentum Factor Equity Growth Strategy, our newest trading strategy and one that I've been demonstrating to you over the past hour piece by piece. And as I promised, I held absolutely nothing back from you. I took you under the hood and showed you every essential component of both the Momentum Factor Income and the Momentum Factor Aggressive Trading Strategy. This is a graph of the Momentum Factor Non-Aggressive or Income Strategy in comparison to the performance of the S&P 500 over the entire 6-year time period. And you can see that the total percentage return over the entire 6-year period would come out to almost 88% return. So if you started with $10,000, you would have gained roughly $8,800. And the total, including the original investment, you would end up with roughly $18,800 if you stayed in the S&P 500 during the entire 6-year period. While the performance in the Momentum Factor Non-Aggressive or Income program would amount to roughly 578% return over the same period of time. And that would amount to roughly $68,000 instead of $18,800, and did not require you to reinvest any profit, while the gains in the S&P required you to hold accumulated profits. So your buy and hold S&P position ultimately became riskier position because your overall profits were also at risk, while the Momentum Factor strategy did not reinvest profits. So even if the market crashed at any point in time during the program, your entire risk would be limited to $10,000 since your accumulated profits were never reinvested. And even in that case, your gain is close to 600%, while the S&P 500 buy and hold gained only a measly 88% during that entire time period. Now let's compare the performance of the S&P 500 in comparison to the Momentum Factor Equity Growth Strategy. But this time, let's compare it to the aggressive model, the one that reinvests all profits back into the Momentum Factor. So if you started with $10,000, for example, and your account now has $12,000, you would allocate the entire $12,000 to the next cluster or bundle. And then let's say, for example, that the total gain results in your account being worth $15,000. You would then allocate $15,000 to your next trade cluster or bundle. And keep in mind, if you're risk adverse, you don't have to trade this model. You can trade the non-aggressive model, or you can reinvest 10 or 20 or 30 or 50% of your profit. You don't have to reinvest the entire thing. But this is the aggressive model. And we started with $10,000. And once again, we're only holding positions for 2 weeks. It includes the bond position for a hedge. So if the market begins losing value, the bond position will begin offsetting the risk. So I feel much more comfortable about holding this type of a cluster instead of putting all of my risk into one stock. My risk is typically spread between 3 stocks and a bond position, and the stocks that we're holding are being bought by every large fund and are moving higher almost daily. That's the reason we're buying them in the first place. So getting back to the example, the profit in comparison to the S&P 500 is staggering. It's so much higher that it's not even a fair comparison between the two. This model generated over 26,000% return, while the return on the S&P 500 was only 88%. And what's ironic was that every stock that was picked or selected was part of the S&P 500, but the difference in performance is staggering, and there's no mystery to how any of this was achieved. It's a combination of the right principles, targeted in growing your overall account instead of finding the next hot stock. And this is how professional fund managers make money from the markets day in and day out. And we have a question from Dana from Rhode Island. And Dana is asking how we can be assured that this type of performance will continue going forward. And Dana, thank you so much for participating. And we've had this question asked a few times over the last 15-20 minutes, so I'm actually going to discuss this topic right now. This concept is very important to understand, and this applies to every trading strategy in the world, especially ones that are high performing and show good results. The concept is called curve fitting, and that simply means taking data from the past and fitting it to the present. And that's something we would never, ever do. Let me explain how this works. And this will actually help you going forward, because this will help you figure out right away if the strategy was based on what already happened in the past or not. The less rules and the simpler the rules, or the less restrictive the rules, the less odds that the strategy is curve fitted to past data. And the more rules the strategy has, and the stricter the rules, the higher the odds that the strategy is curve fitted to past data. If you look at the great majority of my strategies, you'll find that they have less than a handful of rules. Usually there's a trend filter, an entry setup, and that's it. And the setup can fit a variety of market environments. Think of it like a loose fitting glove. It can fit majority of sizes. It may not be the best fit, but it will fit most people. That's how non-curve fitted strategies work. They're based on simple trading principles that continue to work no matter what happens to the overall market environment. But when you have strategies that have very specific rules and conditions, it creates a very tight fit, like a tight fitting glove. One that can only fit one type of hand and no other. And that's exactly how curve fit systems work. It's designed to work with one kind of market environment. And if that environment is no longer present, the system will no longer work. The momentum factor growth strategy is based on relative strength, or picking stocks that are outperforming all other stocks, making sure volatility levels are within average levels, and that correlation is kept to a minimum. These are very basic and solid simple trading principles that have been around for decades. And that means that the odds of them working over the next 40 years is highly likely. If the rules were more like wait for the price to make a 10-day high over the past 30 days, and then wait for the price to make a 10-day low over the next 5 days, and then wait for the price to increase volatility to 20%, and then wait for price to move 1 point higher, and on and on and on. When you have more than a handful of rules, the odds are highly likely that the strategy is curve fitted to past data. And that's something we strictly avoid. Keep in mind that the momentum factor strategy is based on the same principles that ran the Profit Trends Alert ETF program. And the results of that program are in line with what we're seeing here. And that program has been traded for years by our group members. So we're taking the exact same principles that we've used with the ETFs for decades and are now applying them to stocks in the exact same way. We're not reinventing the wheel or trading some experimental approach. We're not using artificial intelligence, any type of wave theory, any type of black box systems. Each asset is picked based on 3 very simple but very powerful principles. And that assures us that this strategy will continue to work over time. The reason the results are so good is because we're continuously holding the strongest growth and tech stocks and leveraging our entire account at all times with the right combination of assets. Nothing more and nothing else. And this strategy can be started with even less than $10,000. I wanted to show you the performance of the strategy in comparison to the S&P 500 when started with $5,000 instead of $10,000. If you started the non-aggressive trading model with $5,000, you would end up with $28,988 in profit over the past 6 years, while the S&P would give you $4,398 in profit. And that's over the whole 6-year period. And if you started trading the aggressive growth model with $5,000, you would achieve $1,332,741 in profit with $5,000. And once again, the S&P would give you $4,398 in profit. And that's over the entire period of time. So the difference is massive, as you can see from the difference in the performance. Keep in mind that hedge funds have been using these exact same principles for years. And I'm sure you've heard of the saying, it takes money to make money. Well, to get into a hedge fund, you have to have a net worth of at least $1 million. That's called accredited investor status. And if you don't have that status, funds can't take your money. And you also have to have a minimum investment of $250,000. And the majority of successful funds charge you 20% fee on all profits on top. So there's a big advantage to using the same heavy-duty trading tactics that hedge funds use without having to give up 20% profit or having to be super wealthy. And give yourself the opportunity to grow your wealth just like big investment firms do. Something that hasn't been available to the average investor till now. And that's what I like the most about the momentum factor growth strategy. It allows you to even the playing field and compete with traders who are squeezing profits consistently from the markets day in and day out. Another major advantage of the momentum factor equity growth program is the ability to trade options instead of the stocks or substitute stocks for options. And that can give you the potential to increase your gains exponentially. Options give you the ability to leverage big and expensive stocks for pennies on the dollar. And the only downside of options is the limited lifespan or the time decay. And because the momentum factor only holds positions for 2 weeks, you have a predefined holding period. And that makes it highly desirable for options traders. Here's an example of a stock pick from one of the clusters. This is Tesla stock, and the position was held for 2 weeks. The stock increased in value, roughly $25, and at the time we initiated the trade, the at-the-money option with 25 days till expiration was worth right around $5. If the trader bought the at-the-money option instead of the individual stock, the trader would have made over 500% return, or 5 times his money, since the option was worth over $25 at the time the rotation ended. So you bought the option for $5, and you sold it at over $25 in 10 days. And if you traded the stock, you would have bought the stock for about $107 and sold it for about $132. Which is a good return, a 24% return. But with the option, the gain is over 500%. And keep in mind that when we liquidate the option, the expiration was still a while away. So we had no chance of having the option expire worthless, since we always rotate the position every 2 weeks. So you can really leverage yourself with this type of strategy. Because stocks like Amazon, Apple, Google, and Tesla have really high liquid options. And since we're holding trades for 2 weeks, we have a set entry and exit date. So it's really easy to substitute options instead of stocks, if that's what you prefer to do. To show you another example of the power of options, let's take a look at another cluster from our trade list. This particular cluster held Amazon for a 2-week period. And the gains from the stock equaled roughly $57, which equaled a little bit over 7% gain, which is a terrific return for a 2-week time period. But let's say, for example, that we bought an at-the-money option, and at the time it was priced at $8 per share, not $800 per share, but only $8 per share. And the option was liquidated the same day that we sold the stock. for a whopping $55 profit. So the stock made less than 10%, actually a little over 7%, while the option made roughly 693% on investment. And the best part about options is the limited risk. In other words, if you hold this option and the market starts coming apart, the risk to your option is what you paid for it. So you can't lose more than that. And the option only costed $8 per share. So your risk is limited to your investment. And remember, we only hold each option for 2 weeks. So the momentum factor methodology can become an extremely aggressive option picking strategy if you utilize it that way instead of simply rotating clusters every 2 weeks. I know some of you don't know how to trade options or have never traded options. So I created a video tutorial that teaches you how to trade options instead of stocks using the same strategy. And it assumes you know very little, and it guides you step by step into how to select the right option and the factors that you need to consider when buying options, specifically for 2-week periods. This video will help you in very simple steps figure out exactly which option to buy, making sure that you get the best strike price, and how to pick the right expiration for the momentum factor strategy. There's no complex spreads or combinations, and you don't have to worry about advanced option strategies. We keep this simple, and we only buy call options since we're not shorting stocks or looking for stocks that are going to trade lower. So there's no shorting or any type of income spreads, just straight buy and call options, and I'll show you how to do it step by step. And keep in mind as I go through all of this, we're only focused on the biggest NASDAQ stocks, ones that have millions shares traded daily. We're not investing in penny stocks or selling naked options. We're not trading forex or investing in gold commodities. We're not buying turnaround candidates, IPOs, or highly speculative small caps. This strategy is very IRA friendly, and IRA accounts don't allow speculative strategies. So we're avoiding all high-risk, super speculative trading strategies, and instead targeting the biggest names in growth and tech. Stocks that are making new highs almost daily and are being bought up by the biggest funds in the world. These are the same stocks that you hear about over and over on CNBC, the same stocks that continuously rise day in and day out and generate massive amount of interest and momentum. And when we turn our interest on these stocks, they're ripe for extended continuous growth, because their relative strength is telling us that they're being aggressively accumulated by hedge funds at the expense of other inferior stocks. And we're simply following price action and relative strength, just like billion-dollar hedge funds do on a daily basis. And one other major issue that we avoid is low liquidity or lack of liquidity. If you've been trading for a long time, then you know that liquidity can be a major issue, especially when you're not investing, but swing trading or buying and selling stocks every few weeks. Because the less liquidity the stock has, the bigger the spread will be between the bid and offer. And options typically have 1/10 of the liquidity of the underlying asset. You'll have very difficult time getting in and out of the option for that stock. And even if you don't trade options and are focused on the underlying stock, you'll end up seeing a wide spread between the bid and offer. And this can really eat into your profits. But in this case, we're trading stocks that have millions of shares traded daily. These are stocks that have amazing liquidity, not only on the stock itself, but the option contract too. This prevents a whole lot of problems because no one wants to trade stocks or options that have a huge spread between the bid and offer. And we avoid that by only trading stocks that have monster liquidity. Also keep in mind, when stocks are outperforming the market and becoming noticeable by large funds, which always happens near 52-week price highs, the stock becomes even more liquid because there's renewed interest in that stock as a result of aggressive growth and price appreciation. that occurs prior to the time the stock made its way on our radar. And remember, we're not holding these clusters for months or years. We have a strict 2-week time frame, and sometimes one of the stocks from the previous cluster will stay on for another 2-week period. So there's a lot of structure to this program. You have a very specific entry date and exit date, and you never hold positions longer than the time frame specified. This is not one of those programs where you'll have to hold a losing position for months till it comes back to your entry point. The momentum factor does not hold on to losing positions and continuously rotates into winners. So it's active and focused on staying with the strongest performing stocks every 2-week period. And when we do end up holding one of the stocks for the next rotation or the next 2-week cluster, the reason we would do so is because the stock continues to outperform all other stocks and continues to demonstrate amazing relative strength in relationship to the rest of the market. In other words, the stock is performing very well. Otherwise, we wouldn't continue holding it. So the momentum factor growth stock strategy is not going to cause you to hold on to losing trades. We want to always stay with winners, and that's the goal of the momentum factor growth strategy. One other factor that I'd like to point out is the high percentage of winning trades. Over the entire 6-year period, roughly 70% of all trades and clusters have been profitable. And there's a very specific reason for that, and I want to explain it to you right now. This is very important, so please pay close attention. This information will help you going forward, regardless of what you trade or how you trade. In this example, you can see Amazon stock. Notice that we have a stop placed using a very common method, which is a 50-day moving average. This is one of the most popular and most recommended methods by gurus and most investment and trading books to protect against loss. Notice both times. The stock gets taken out, and shortly thereafter the stock reverses once again and heads back up. This is very frustrating, and it happens all the time. You pick the right stock, you pick the right timing, and the stock pulls back just enough to stop you out, and then continues moving back up once again. If there's anything more frustrating than missing a big price move, it's finding the right stock only to be stopped out right before the big move occurs. The reason why this happens is because most traders don't give stocks enough breathing room to move around and fluctuate randomly, which is necessary for the stock to be able to do. Every stock has a specific random volatility level, and if you don't know that volatility level and impose a predefined protective stop that's based on anything other than the stock's volatility level, your protective stop is not based on volatility, but instead on some derivative of price or an arbitrary level that's based on your risk level. So in effect, the trader is ignoring volatility action once again, and instead relying on factors that have no connection to the actual volatility of the underlying asset. And that's exactly like the example that I gave you earlier, where the driver drives the car while looking at the rear view mirror and avoids looking ahead. And that'll cause you to crash and get into a major accident. And that's exactly what will happen to your trading account if you don't take into account volatility and instead rely on protective stops using arbitrary risk levels. In my swing trading program, for example, we use stops. Every stop loss is based on the current volatility level of both the overall market and the stock that we're trading. So if you do intend to use stop losses, please make sure that you use some type of volatility measurement to determine where to place stops, and don't rely on indicators or arbitrary price levels. They will cause you to not only get stopped out prematurely, but will also prevent you from participating in a major price move. But the momentum factor equity growth strategy instead uses bonds to hedge against unforeseen losses and combination of clusters. So the risk is spread between 3 offensive assets and 1 defensive asset. And this way the positions do not get stopped out and can fluctuate naturally, similarly to how they would during a buy and hold period. So instead of using stop loss orders to mitigate risk, we're reducing or mitigating our risk by spreading it out, by diversifying across 3 stocks in different industries and 1 defensive bond position. And because we're constantly rotating positions, we eliminate the weakest stocks and shift into the strongest stocks. So we use diversification, 2-week time periods, which are in effect called time stops, and bonds to offset risk. And the great majority of the time, it benefits the overall account growth and allows the stocks to fluctuate naturally. And that gives the stock the unrestricted ability to move directionally without interference. And in trading, the biggest enemy is the trader, who usually gets in the way of the stock making a big move. So by managing risk a bit differently, we get to increase our percentage of profitable trades. We increase the gain on the trade as well. And most importantly, we don't cause massive drawdowns, which can damage your account beyond repair. Take a look at the following 2-week rotation, for example. It occurred between September 15th, 2011 and September 30th, 2011. The cluster must have been initiated when the overall market was becoming bearish. I can tell that much by looking at the allocation of the bond in the cluster, which was at 50%. Typically, if the market is bullish, we'll only have about 10 or maybe 15% in the bond position. But when we show 50% allocation in bonds, it means that the market is more than likely getting a bit ahead of itself, and either corrective action or range-bound trading action is expected. The result of the cluster was a net win. But if you look at the cluster itself, there's 1 loss and 3 winners. And the biggest winner is the bond position. And instead of getting stopped out or having to just waste 2 weeks of time and having to rebuild lost profits, we're able to take advantage of a 2-week corrective action and not only maintain our account balance intact, but are able to thrive in this market environment and increase profits and turn a lackluster 2-week period into a good-sized winner. And the point that I want to make is simple. It's much easier to create a cluster based on the current risk level, market sentiment, volatility, and correlation than to arbitrarily pick a stop-loss level for each stock based on factors that have nothing to do with actual market price. And the results speak for themselves, because usually momentum strategies are lucky to be profitable 40% of the time. The 50-day breakout is accurate about 40% of the time. So when you get accuracy into the 70th percentile while trading momentum stocks that are moving very strongly, directionally, you're taking advantage of very powerful price movement and at the same time protecting your position beyond even the most defensive and conservative strategies out there. In other words, the momentum factor growth stock strategy gives you the opportunity to seek aggressive gains and at the same time gives you roughly 70% winning trades, which makes it not only a high-performance trading strategy, but also a very accurate one. And typically, you'll find that high-performance trading strategies have very low percentage of accuracy. So the momentum factor equity growth strategy gives you both in one simple-to-follow strategy, and at the same time helps you tremendously to avoid getting stopped out prematurely. So now that I've explained to you the dynamics behind this strategy, which is called the Momentum Factor Equity Growth Program, and over the last hour and a half, I've been explaining to you just how this methodology works. And as promised, I didn't hold anything back from you. And now I'd like to tell you a little bit more about the program that we've been very busy researching, developing, and putting together quietly behind the scenes. And I made sure to include 2 bet sizing models. One that doesn't reinvest back into the program, That's the income model. And the model that reinvests absolutely all profit back into the model. And that's the aggressive model. So I made sure to include both in the program. And this program is specifically designed to bring heavy-duty hedge fund performance to the average investor or trader, one who doesn't have the accredited investor status, where you have to have a net worth of at least $1 million and allocate a minimum of $250,000 to be accepted into a real hedge fund. And you don't have to give up 20% of your hard-earned profit back to the hedge fund manager. You get to keep everything for yourself. As a member in the Momentum Factor Equity Growth Program, you'll get access to your own personal members portal. And every 2 weeks, you'll receive a rotation alert. This alert will be emailed to you and posted in your members portal. And we also started using a text alert service, so you'll receive a text alert as well. Also, each day, we will update you on the closing price of each stock that's in the cluster, so you'll know at all times what position the Titan is holding. So there's no surprises here. Your portal will contain a getting started video. These videos are designed to get you going from 0 to 60 in about 1 hour. Your members portal will also contain a daily coaching and market recap or review. So Sunday through Thursday, you'll get a detailed analysis of the current market environment and how that impacts our cluster. My daily reports are very informative and will not only help you make sense of the current market climate, but will also help you understand the financial markets from my perspective, which is invaluable. And that'll increase your confidence in your own trading abilities. And when traders are confident in their trading, they tend to trade bigger positions and increase their profits. In other words, my daily coaching will help you become a better trader. And that's included in the Momentum Factor Equity Growth Program without any additional cost. So if you want to learn to fish for yourself, these daily coaching and analysis sessions will make a big difference in how you view the markets and hopefully will reflect in your bottom line. And lastly, I include the Momentum Factor Options Growth videos to help you adapt the Momentum Factor program to options for those of you who trade options instead of stocks, to help you leverage the Momentum Factor Growth program even further. Your personal members portal will also hold 2 portfolio spreadsheets. Each spreadsheet will have every trade that was taken from the time the program started to the present time. One spreadsheet is the non-aggressive income model that trades consistently with $10,000 every cluster. You don't have to start with $10,000. You can start with a smaller or a larger amount. We just happen to use a $10,000 account to keep things simple. The other spreadsheet tracks the aggressive model, the one that reinvests all profit back. Keep in mind that the trades are identical. The difference is how we manage our money. This is called bet sizing, and it will help you understand exactly how professional traders are able to leverage their account for maximum growth. But instead of teaching you how to do it, I'm actually going to show you how it's done. So this won't be theory. You'll see exactly how both spreadsheets update, and you'll see absolutely every detail. The entry price, the exit price, the share size, absolutely everything is disclosed and updated on these spreadsheets. You will also get to download each of the spreadsheets and keep track of your own trades the exact same way. And this will get you into the habit of keeping your trades organized using the same portfolio spreadsheets that we use in the members area. We want you to be able to compare our performance against your performance. So everything we do in this program will be extremely transparent, just like our Profit Trends Alert program, which is the ETF program that we've been trading using the exact same type of methodology for the past 6 years. And I'd like to show you 2 capsule summaries. The first capsule summary is the non-aggressive momentum factor model, and this one was started with $10,000, and we never reinvest anything. You will see this complete spreadsheet in the members area, and we take out all profit at the end of each 2-week period. Take a look at the performance of the strategy. This is the same capsule that's on the bottom of the spreadsheet that's in the members portal. So you'll be able to see it update with every trade every 2 weeks. So let's take a look at some important figures. The first pertinent row is the net profit row, which tells us how much the strategy gained over the entire period. And that's from beginning of 2010 to the present. The net profit is almost $58,000, which is 579% return. And that's amazing if you consider that we don't reinvest or risk any of the profits back into the strategy. The next important figure is the profit factor, which is 4. And the profit factor tells you how much you make on average for every dollar that you risk over time. And anything over 2 is considered to be a high profit factor, because logically, when you risk $1 and you make $2 back over time, you're doing well. But in this case, the profit factor is 4, which tells us that over time, based on all the trades taken over the past 6 years, the average profit for every dollar that we risk is $4, which is one of the highest profit factors that I've ever come across. This clearly tells us that the momentum factor strategy is based on very solid principles, which have not changed since we started trading the strategy. And that's very important. We don't want to trade a strategy that's like a moving target, where the rules evolve over time, because that's one of the hallmarks of curve fitting, which I explained previously when I gave you the example of a tight-fitting glove and a loose-fitting glove. And the less we change the rules over time, the less chance that the strategy is curve-fitted. And with the Titan, we never adjusted or changed anything. And moreover, it's based on the exact same principles that we've applied to our ETF strategy for the last 20 years, before ETFs were ever created, when we had to resort to trading futures instead. So the momentum factor is based on very, very solid principles and was built on a very solid structure, which is very important for traders who are looking to trade the same methodology for many years. The next figure that I'd like to focus on is the percentage of profitability. And notice it's right around 70%. It actually fluctuates between 69 and 71%. And this is based on almost 600 total trades. So there's some history behind these numbers. And the more stability we show over time, the stronger the odds that it'll perform similarly for many years to come. Notice the number of consecutive winning trades. There's 14 winners in a row and only 5 losers in a row, and close to 600 trades. And that tells us that the strategy has a very strong level of stability over time. And once again, I'd like to show you the graph of the S&P 500 in comparison to the Momentum Factor Equity Growth Program. The S&P 500 over that time period returned roughly 88%, while the Momentum Factor Equity Growth Program returned almost 600%. And when you held shares in the SPY or the S&P 500, you held the entire position. So when the stock market lost value, each time your account was at risk. And the biggest drawdown during that period for the SPY was over 20%. So your entire account was underwater for over 1 year. And that means your money was recovering for over 1 year and wasn't working for you. And you risked not only what you started with, but also everything that you've accumulated up to that point as well. So imagine you're holding a position in the S&P 500 and it's doing really well. And in the end of the 6-year period, when your account is finally worth something, the market tanks and you experience a 20% correction. That means your entire equity will have a drawdown or a loss of 20%. Till the S&P comes back, which can take years and years, as most of you know. The Titan non-aggressive growth strategy only has $10,000 at risk at any given time and was never underwater beyond 7%. So you were able to grow your account exponentially, and at the same time, your account was never at risk beyond 10%. So your risk never exceeded $1,000 on your $10,000 account, which is a big difference from what you would have experienced with the S&P 500. You would be stuck nurturing the position and waiting for your funds to recover. And my idea of money working for me is not waiting for over 1 year for my account to go back to its original value. That's not how you grow your account aggressively. Now take a look at the capsule summary of the Momentum Factor Equity Growth Aggressive Trading Model. And here we do reinvest our profits back into each cluster or 2-week trading block to aggressively leverage our account growth. And this account was also started with $10,000. But because the strategy is so powerful, we only hold positions for 2 weeks. We were able to use the power of bet sizing or money management to maximize our growth by putting all profits at all times back into the system. And when you get inside the members area, you'll see the entire spreadsheet, and you'll see each entry and exit and each trade one by one. And you will see exactly how we reinvest all our assets into each cluster. So there's no mystery or magic to any of this. You will see it step by step every 2 weeks when we rotate our clusters. So getting back to the cumulative capsule summary of the Momentum Factor Equity Growth Aggressive Model. The total profit over 6 years, reinvesting all profits, yielded over $2.5 million in 6 years, which in my experience is the most aggressive account growth I have ever seen. And the biggest drawdown or underwater period was no more than 10% during the entire 6-year period. And we've had plenty of bearish corrective cycles during this period of time. So the model performed in both bullish cycles and bearish cycles profitably. The profit factor, which once again is the profit that you gain on average for every dollar that you risk, is 3.5. And as I mentioned previously, anything above 2 is a healthy profit factor, because at that point you're profiting $2 for every dollar that you put at risk on average. But to see a profit factor of 3.5 is very impressive, considering we're not talking about a small sample size of 10 trades. This is over a period of 6 years and close to 600 trades. So we're talking about a reasonable size sample. The percentage of profitability is at 70%. And I also mentioned earlier that it fluctuates typically between the high 60s and the low 70s, which is very impressive because most momentum strategies that focus on aggressive gains have a win rate of 33 to 50%. They make their money because the profits are so much higher than the loss. But overall, momentum strategies are not known to have a high percentage of winning trades, but this one is different. But interestingly, the percentage of winning trades is also in line with our ETF models, which have been trading for several years. So what I'm seeing here is very much in line with my experience. And once again, the reason we have such a high percentage of winning trades is because we're using bet sizing, bonds, diversification, and correlation to help us offset risk instead of using traditional stop-loss orders, which can prematurely stop your position out before it takes off for that big move. This is a chart comparing the performance of the Momentum Factor Aggressive Model in comparison to the S&P 500 over the 6-year period of time. And you can see that there's really no comparison. The performance is not even in the same ballpark. The performance of the S&P 500 over the 6-year period is roughly 88%, while the performance of the Momentum Factor Aggressive Model was over 26,000%. And just to be clear, we reinvest all profits back into the aggressive model, something that we did not do with the income model. And once again, inside the members area, we have both spreadsheets, line by line and trade by trade. And you can see every trade that was taken, the share size, the entry, the exit, absolutely everything. So there's no mystery to any of this. And I'd like to read you a testimonial from one of our beta testers and a longtime Profits Trend Alert group members. Roger, I've been using your various strategies and systems for over 4 years. And I was honored that you made me part of your Momentum Factor Equity Growth Beta program. When I started trading the Profits Trend Alert model, I was very excited, but was curious how the approach would work with stocks. And finally, I don't have to wonder any longer. After investing and trading in multiple trading strategies, hedge funds, and investment pools, I can tell you with 100% certainty that you have a winner on your hands. This methodology is a beast and the only way to trade fast-moving growth stocks. Thank you, James Danbury, New York. And James, if you're participating in today's training, I'd like to personally thank you. That was very kind of you. So today we're launching the Momentum Factor Equity Growth Program. And once again, I'd like to summarize everything that you get when you sign up for the Momentum Factor Growth Program today. First, you get 24/7 access to your private members portal, where you'll find the step-by-step video getting started guide that'll explain in detail all the details that are involved in trading and executing the Momentum Factor Equity Growth strategy, both the non-aggressive and the aggressive growth models. The members portal will also contain the current positions and the spreadsheets for all closed and open trades, so you'll know at any given time what position we're in. Every 2 weeks you'll receive an email with a rotation alert, and you'll also receive a text alert, so you'll never miss a trade. The alert is generated the day before the rotation, so you'll be able to check the members area, check your email, and check your phone for a new rotation every 2 weeks. So it's going to be virtually impossible for you to miss a trade if you have access to either your phone or your computer. In addition, as part of your membership, you'll get daily coaching from me, and this includes a daily write-up of how I personally view the current market sentiment, how I analyze momentum levels, and how I interpret market action. So not only will the members area have the current position, but you'll also receive a complete coaching and analysis between Sunday and Thursday each week. And this will give you a chance to really get inside my mind and get inside my thought process. I use a top-down approach to analysis, and I start with global markets and work down from there. And after you read my analysis for a few weeks, I can assure you that you'll start seeing the markets very differently, from a very different perspective. And this will increase your confidence in your trading and cause you to increase your position size. I've been told this repeatedly over the years by thousands of students, over and over. So I'm giving you the exact same feedback that I'm getting from traders who've been with Wealth Press for years. And I mentioned this previously, but I want to be thorough. I'm also including a step-by-step video called Momentum Factor Options Growth, and it explains in detail the strike price and the time frame you want to use if you intend to trade options instead of stocks in the program. And if you're new to options and don't want to waste too much time getting into the Greeks, I keep it very simple and explain just what you need to know to execute trades using options instead of the underlying stock, and what the consequences are of going further out of the money or staying closer to the money. So I explain all of this as it pertains to the Momentum Factor Equity Growth Strategy. You also get 2 downloadable spreadsheet templates, one for the Momentum Factor Income Model and one for the Aggressive Growth Model. So this way you can keep track of all the trades every 2 weeks, just like we keep track of the issued trades. When you get the order instructions every 2 weeks, they'll be crystal clear, and there's nothing for you to interpret. We tell you what to buy and what to sell, and we tell you exactly what percentage of your account equity goes into each stock. And our Getting Started guides inside the members area explain this in detail. So the entry and exit or rotation instructions come at the same time every 2 weeks and give you step-by-step instructions on what to do next. This is a follow-along or done-for-you program. So all you have to do is place the orders every 2 weeks, which only takes a minute. The Momentum Factor Equity Growth Program is not a methodology that requires much of your time. So it's designed for people who have a life outside of the markets. You can go on vacation or go on a business trip and utilize this strategy. It does not, and I repeat, it does not require you to sit in front of your computer all day. And lastly, you get full email support from us. We're known to offer our members amazing support, and we will make sure you understand absolutely everything. Our customer service is very detail-oriented. So if you have a question or need clarification, we usually respond immediately or within a few hours. Our members routinely tell us we have amazing customer service, and that's because we truly want to see our members succeed. So today, and we're only doing this today because we're releasing the Momentum Factor Equity Growth Program to the public for the first time, we're opening the doors to 50 members. The regular price that you'll see on our website is $29.97 for 1 year. But we want to give everyone, even the small trader with a tiny account, a chance to compete with the large multi-million and multi-billion dollar hedge funds. So today we're offering the 1 year of the Momentum Factor Equity Growth Program, and that includes both the income and the aggressive growth model for only $14.97. And that's one offer you'll never see again. I can promise and guarantee you. This is a ridiculously low price for a methodology that can match returns with some of the biggest and most successful hedge funds in the world. And you can have access to the same state-of-the-art methodology and guidance from me for less than $5 per day, which is an amazing deal if you consider how little we're charging for such an amazing service. So if you want to learn more about the Momentum Factor Equity Growth Strategy, both the income and the aggressive growth models, and both models are included in the program, follow the link on the screen now. This offer will only be open for the next 24 hours or till we fill 50 spots. And from the feedback that we're getting at this time, all spots will be completely taken within the next 24 hours. And don't forget, I'm also including the Momentum Factor Options video tutorial so that you can apply the Momentum Factor strategy to options. And I'm very confident that the Momentum Factor Equity Growth Program will be able to generate returns just like it did in the past. And if the Momentum Factor Growth Strategy does not outperform the S&P 500 over the next year, you'll get the next year in the program on me. Keep in mind that this program uses the same methodology that we've used in our highly successful ETF program. And that program continues to beat the S&P 500 year after year. As a matter of fact, it's up 4 times the return of the S&P 500 this year. So I'm very confident that the Momentum Factor program will beat the S&P 500 over the next year, or you'll get 1 year on me. And I've never ever seen anyone give such a performance guarantee before. And the reason why I'm doing so is because I have lots of confidence in my strategies. And I create them with long-term performance in mind. So if you want to learn more about the Momentum Factor Equity Growth Program, the income and aggressive return models, please follow the link on the screen. And remember, you don't have to start trading with a large account. You can start with a small account. This is an example of a $5,000 account. And in this summary, you can see what the $5,000 account would turn into if you bought and held the S&P 500 over the course of the last 6 years. And notice that the returns over the entire 6-year period are far from stellar. And then it shows you the Momentum Factor Equity Growth for the income model. This one was started with $5,000, and $5,000 was reinvested into each and every trade over the entire 6-year period. And the return over that period is $28,988 in profit. And your risk was less than the buy and hold in the S&P 500 because you held accumulated profits with the S&P at all times. So when the market corrected, so did your accumulated profits. But here you took out profits and treated the program like an income strategy. So your risk at any given time was limited to $5,000. And that's assuming all stocks drop to zero, which is not likely when you're trading the biggest growth stocks on the planet. And then the last example are the returns for the Momentum Factor Equity Aggressive Model. And you can see the returns are something else, coming in at over 26,000%. And that's truly amazing. all with a drawdown of less than 10% during the entire period of time. And this is what your $5,000 would have turned into over 6 years. And this, my friends, is called the power of compounding growth. And this is how the richest people in the world continue to grow richer. So don't delay if you want to take charge of your financial future and trade the same way as multi-billion-dollar hedge funds. I highly recommend you follow the link on the screen and enroll in the Momentum Factor Equity Growth Program before all spots are taken. And because this is an introductory offer, the odds of us selling out over the next few hours is a very strong possibility, which is why we've offered only 50 spots. So don't delay or procrastinate, because this is a hot program and it makes a lot of sense. We're turbocharging a very stable trading strategy and its performance speaks for itself. So don't delay and click the link on the screen before it's too late, especially at the ultra-low introductory price. It's just an amazing deal, and I want to give you a chance to sign up today before all spots are taken. Okay, so let's take a few questions. We've been going on for over 2 hours, and I hope I covered everything. But I'm sure there's a few great questions out there. And yes, we have a good question from Terrence from Atlanta. And Terrence is asking if there's any inverse assets that we trade. And Terrence, there's no inverse assets. They're typically not allowed in an IRA account. And the Momentum Factor program lends itself to IRA accounts, since there's no shorting or inverse positions. And in the members area, we also tell you which bond ETF to use for IRA positions. So we got you covered, Terrence. And yes, you can start with a small account and build it up from there. You can start with a few $1,000s and begin with the aggressive growth model. And once your account gets up there, you can lower the level of aggressiveness or completely trade it as an income strategy. And once again, to learn more and enroll in the Momentum Factor Equity Growth Program, please click the link on the screen. And we have a question from Tina from Cleveland. And Tina is asking how much trading experience is necessary to trade the Momentum Factor Equity Growth Model. And Tina, this program requires zero market trading experience. We offer a getting started guide in the members area and tell you which stock to buy and also if there's an ETF position as well. The only thing you have to do is figure out how many shares to buy based on your account size. We give you the allocation, but we don't know your account size. So if we say buy 33% of stock A, 33% of stock B, and 33% of stock C, and say you have a $10,000 account, you would simply allocate 33% or $3,300 to each of the 3 stocks. And that's it. It really doesn't get easier than that. And if you get stuck, you can look at the spreadsheets to see examples of all previous allocations. And you can email us, and we'll email you back very quickly. We want to make this simple and easy for you. Also keep in mind, Tina, if you're interested in learning more about the markets and how to trade on your own, my daily coaching will help you get up to speed very quickly because I tend to be very analytical and I go deep into market action. So if you're hungry for financial knowledge, you can read the daily reports. And if you just want to benefit from the Momentum Factor Equity Growth Program and you don't care about ever doing it yourself, then you can ignore my daily analysis. It's up to you. And I'm being told that the Momentum Factor Equity Growth Program is now halfway full. So if you're interested in getting started, I highly recommend you follow the link on the screen and enroll in the Momentum Factor Equity Growth Program before all spots are taken. And before I finish up tonight, I do want to reiterate that the Momentum Factor Equity Growth, both the income and the aggressive models, are very different from traditional retail strategies and are based on principles that are applicable to large private hedge funds that trade millions and billions of dollars. And the Momentum Factor program will give you access to the same institutional heavy-duty trading principles that till now have been reserved exclusively for professional traders. So if you want to transform your trading results and take your trading to a whole new level, I highly recommend you enroll in the Momentum Factor Equity Growth Program. To learn all the details, just click the link on the screen. And I recommend you do it now before all spots are taken. Okay, I had a terrific time today. I really want to thank you for making this a fantastic training session. And thank you for all the terrific questions. If you have any questions, please feel free to email me at support@wealthpress.com, and I'll get back to you shortly. And if you'd like to learn more about the Momentum Factor Equity Growth Strategy, please follow the link on the screen. There's not many spots left. So if you're interested, it's a great time to take action and take your trading to a whole new level. This is Roger Scott wishing you the best.